time to go through. Okay, so this question that we are presented with is an exam question. Of course, this time in this session, we use some question from the University of Zambia, and the question is number 4. It is reading that the following information relates to the only product manufactured and it is sold by this particular company. So the company is manufacturing a product and it is selling the only product in question. So as the company is doing that, what is it that we are expected of doing? So get that this company has got the following costs. Okay, it has got the following costs. They have got the direct material cost as they are trying to manufacture, given in the question, and the costs are given per unit. Okay, you can see the cost per unit there on top is 55, and the direct labor costs per unit standing at 45. Then you also have the variable production overheads cost, and these standing at 10. And then from there, you also have got the other costs, and that's actually the variable sales and marketing overheads at 8. The other data that you're given are the levels of activity, or the units that were produced in the month for the 3 months. Of course, the 3 months in question: January, February, and March. So given the additional information, so the additional information says that's number 1. The first note we are given that the budgeted fixed production overhead was actually 500,000 per year or per annum. And then the actual fixed production overhead for the period was 45,000 per month. Then the sales marketing overhead, they are of 35,000 per month, and the administrative overhead of 20,150 per month. Actually, these were in line with the budget for the period. The other note, the fourth one, is saying that all the fixed overhead costs are budgeted on the basis of the projected volume of 80,000 units per year or per annum. Okay. So the most important part again to get is that on note number 5, the business does not actually expect to have any inventory at 1st January. So in short, we do not have the opening inventory. So let's start from question number B2. It says, can you prepare a profit statement for each month using each of the following verses? We can start with marginal costing so that in the next conversation I give you the other one, which is the absorption costing. So how do you go about marginal costing? How do you prepare the statement using the marginal costing? Now, the marginal costing way of preparing for the profit and loss statement is just almost same or similar to with the manufacturing company. The other thing that we are noticing here is that we are also having a situation where we're dealing with this company that is of course the company is involved in production, so they're manufacturing. Then when we are dealing with these questions, we are never given the closing stock. I'm showing you the differences from the common financial accounting.
Which question are we solving? I mean, are we looking at?
Hello? The question. So I've moved it to the whiteboard so that we start writing. You can see the question?
Yes, are we dealing with A or D?
B2, like marginal costing. I want to communicate marginal costing.
Oh, okay.
All right. So how do you go about this one now? So I've said number one, you're never given the closing stock this time around, unlike the way how it used to be those days. You'll be given the the closing stock. So here you have to calculate for the closing stock, and just some few changes. Then when you're dealing with marginal costing, actually from the sales, you just less the variable costs only in the calculation of just use the variable costs. Only the variable costs are to be deducted from the sales for you to get, the not really the gross profit, for you to find the figure that should help you to calculate for the closing stock. I'll repeat that point. It's a very important point. Under marginal costing, it is also variable cost when you are deducting from the closing stock. And you will observe that. Okay, just watch nicely. So just like any other statement, even this statement, it starts from the sales. Okay, remember the profit and loss. Okay, it starts with the revenue or sales, right? How can you find sales? So in the question, are you able to see the selling price? I need some. Do you have a calculator where you are, Vivian? You need to be calculating at a faster rate this time around. Do you have a calculator? Can I have a calculator? Hello?
I'm using the phone myself. I'm gonna use the phone.
Okay. All right. So let's continue. Every time you come for for these conversations, it's very important that you have you prepare yourself. Anyways, let's go ahead. So the selling price is given on top, and the units that were sold. We'll start with January. I'll just do January and February. The March for January. You
Can't
get
hear
the
you
units. You say 180 times. You can't hear me.
Yes, the sound quality, some kind of not the way it is, or the Mankalila wants some kind of something else anyway.
Okay, you can't hear me now. Can you hear me?
Maybe use the the headsets.
You cannot hear me.
Mm-hmm.
Oh, I'm low.
Yeah,
You
low
can't hear.
and yes. No, I mean.
Okay. Okay, let me try to do this. Okay, can you hear me now?
Yeah.
You can hear me now?
Yes, sir. Yes, sir.
No. Okay. That's right then. So what is 180 180 multiplied by the units that were sold in January? There were 5,800. Can do that quick.
That's 1,044,000.
5,000 times 555.
1,044,000. So that's the selling price multiplied by the units that were sold. There were 5,800 in January.
Sir, wait, what are we calculating?
We're calculating for the sales. We are finding the value of sales. Remember, every normal statement, it starts from sales. Like the normal profit and loss. You remember the normal profit and loss from financial accounting? Just like that normal profit and loss statement. It starts from the sales, isn't it? You start with the sales, yeah?
Yes, sir.
No, you have forgotten. Okay, so 180 times 5,800. So as you said, it gives us 1,400,000.
1,044,000.
Or 1,044. 104430 like this.
Yes.
Okay, that's right. So from the sales, what do we do next? We usually less cost of production, isn't it? In the normal,
Yes, sir.
the normal way how you get the statement. Costs or production costs. So I would really request you at your own also time to just go get the format, and you are okay. You should have the opening stock, isn't it? You start with the opening stock of the finished goods. So the opening stock, we are told in a question that in January we don't have the opening stock, isn't it? That's what the question said. Note number 5. It said that the business does not expect to have any inventory at 1st January. So you don't have opening inventory. Okay. So what do we do next? So to the opening stock, we can add now the other production costs. Okay. And let's add the production costs. The production costs include the following. The production costs, and let me be specific. These are variable production costs, not any other costs. In marginal costing, we just use the variable cost, not the fixed cost. So we add the variable production costs. And so for the variable production costs are made up of the prime costs. Prime costs, you know that all the prime costs are variable costs, plus the variable overheads, okay? The variable production overheads, right? Now those overheads that are variable. Of course, we are just concentrating on those that are production in the production department. So that is fine. We know that the variable costs are made up of the direct material costs. Let's find the direct material costs. How much is it? We're given the cost per unit, right? We're given the cost per unit being 55 for 1 unit. So how many units were produced in January? Are you able to see the production units, like the level of production? Like these are units down here below, the level of activities.
That's 7,000.
So you say you multiply by 55. That will give us the direct material cost.
So that's 385,000.
385,000. 385,000. Then we can add now direct labor cost, yeah? Direct labor costs. How much is the direct labor cost? 45 times what has been produced. We have produced 7,000 units. How much is that giving us?
Uh, 315,000.
So 315,000. And then from there, if you have direct expenses, you can add them because they're prime costs. They take place in the production. Then you need the variable production overheads. You get that point? It's very important. You can add the variable production overheads. Okay. So the variable production overheads, there are those overheads that take place within the factory. In other literature or in other books, you can find this written as factory, variable factory overhead. So the cost is 10,000. Oh, sorry, it's 10 kwacha per unit multiplied by, the level of production, which is 7,000. And what does that give us?
70,000.
Okay, that gives us 70,000 for the variable. These are variable. Okay, I'm hoping that people are following nicely. This is marginal
costing, the difference is just so variable production overhead up with this, you're fine. So 70,000. So once we have found this amount, then what do we do next? Okay, we need to add the figure, the value that we're going to do. Let's add all these, like just add all of them all together.
$770,000.
700 and
70,000.
70,000. So now we need to calculate for the closing stock from this. Okay, this cost we need to less the closing stock. Less what? Less the closing stock. How can we find the closing stock? This is where the question is now. How do you? Because we need to calculate using this value, the closing stock. So pay attention to me. And please emphasize, can you pay attention? How do you find the closing stock? The closing stock is calculated by the difference minus C, the units what? Okay, by how many units have been produced altogether, multiplied by, you know, the cost.
Sir,
What
come
cost?
again. I was having, hello? Come
Mhm.
again. I was having some network challenges here. I didn't
No,
hear you
it is
properly.
well. It is well. It is well. No worries. So I am saying for you to find the closing stock, you have to get this cost, this same cost. You say cost multiplied by the production units minus the units that have been sold, and we divide everything by the units that have been produced. Okay, that will give us the closing stock. So we have to go and establish the cost is already there. The cost is already there. And how much is the cost? The cost is 77,000 multiplied by 77,000 multiplied by the difference between what has been produced and what has been sold in this period. What has been produced and what has been sold. How much has been produced?
Uh, 7,000 units and sales 5,800.
Exactly. So you get the difference. Get the difference of that. Okay. Just get the difference. Out. And once you find the difference, then you should define what should be the difference.
It's 1,200.
So it's 1,200. That's the difference. So 1,200 will be multiplied by the very costs. 1,200 multiplied by the very costs, like this same cost, 1,200. Then you divide by the units that were produced. There were 7,000. So you can work out the closing. Find the closing stock.
Uh,
142,000.
142,000.
The numbers sound different. Vivian, what I'm finding? Vivian.
140,000.
140,000. Are you finding the same, sir?
No, it's 132,000. So the total of the direct material, so the prime cost, the total of the prime cost and the variable production overheads It's 770,000 and not 77,000.
Oh, okay. So there's a, okay, 770,000. So there is another zero here. So you can work out that, and what I find now, when you do those adjustments, sorry for that. You know, apologies for writing like that. What are you finding now? Uh, 44,000. How much did you find? Hello?
Yeah, so I found 132,000.
Oh, 132,000.
Still
Okay.
finding the same.
No, can you redo your work again?
No.
770,000 times 1,200. When you find your answer,
No,
then you
okay.
divide by 7,000 units that have been produced. Okay. So basically, this is how you find the closing stock. Okay. This formula is very important to write. How to find closing stock. People get stuck just here. Okay. Closing stock is never given, so you have learned how we calculate for the closing stock. So now, what's the difference? Like 770,000 minus 132,000. What's the difference?
7,000.
So the difference is 638,000.
770,000. 638,000.
Yes, less 132,000.
Are you following?
Yes,
Okay.
I don't know what's going on today.
Okay, 638,000. So now to the what? To the opening stock index, it will still remain the same, 63. Last column, so that you can deduct it from what? From the sale. Deduct this value from the sales.
Uh, 406,000.
406,000, which is 206, yeah? Okay, 260,000 he has found.
406,000.
406.
Yes.
Okay. 406,000 as a difference. That's interesting. Okay. So now, hold on, just here. I think there is an error that we made here. Just a minute. When we do, after we have deducted, we have added the opening stock to this difference that we got from the closing stock. We are also supposed to add the variable non-factory costs. Like there are those variable costs, right? The variable costs that do not take place in the factory, they need to be added here. And have to add them down here. There are those variable, the variable costs that don't take place in the factory. Remember, these variable production costs take place in the factory. So there are other variable costs such as the variable sales and marketing. Those marketing is not done in the factory. So that's 8. So you have to get that cost and add it. So 8 times the production level, which is 70,000. What does that give us? Eight times 7,000, not 70,000. 8 times 7,000.
56,000.
56,000. So that amount is to be added to 638,000 so that you can find the value to deduct from the sales.
So that would be 694,000.
694,000. That amount now to be deducted from the sales so that it can give us the contribution. Okay, and deduct that from the sales so that you can get now the contribution.
That's 350,000.
Okay. You said it is
694,000.
Okay. Hold on just there. You did the 8 times the 7,000.
Yes, which was 56,000.
It was 56,000.
Yes.
Then you added the 638,000.
Yes, which gave us 694,000.
694,000.
Yes.
You're also finding the same, Vivian, yeah?
Yes, sir.
Okay. So that difference, then you should deduct it from the what's this? From the sales. So the value that you find is called the contribution. It's not gross profit. Okay. Contribution. What's the contribution?
350,000.
350,000. Let me just erase everything so that it's easier. So contribution, said it's 350,000, right?
Yes.
Okay. So from the contribution, you can now less fixed costs. Okay. Less fixed what? Costs. Now, when you're lessing the fixed cost, you know that the fixed costs are categorized into the production fixed costs and non-production fixed costs, isn't it? Yeah, there are those production costs. So you can less the fixed production costs. Production costs, those are fixed costs. And how much were these? Let's get back to the question. The question will give us how much goes the fixed production costs per month. How much is it? Have you seen adjustment number 2? Note number 2. It says the actual fixed production overhead for the period was 45 per month. Did you see that one?
Yes, sir.
Mm-hmm. So you write that one, 45,000. Then you also have to consider the other fixed costs, like the fixed sales and marketing overheads. The fixed sales and marketing overheads. You've seen these, the sales and marketing overheads, they are 35,000 per month. You've seen them? Same as the administration overhead as well.
Yes, sir.
They are all 20,150. So we can start with the fixed what? Fixed sales and the marketing. This was 35,000. Then the administration, the administrative overhead being 20,150. Then you can add all these together just add them together, and we subtract them, the total from the contribution. Just add them all together.
Sir, this contribution, is it a continuation from what we are doing?
What do you mean by continuation? I'm not understanding your question.
I mean, is it a continuation from what we are doing, calculating sales, production, primary?
Yes. Like we are continuing this contribution thing, like you should continue writing down. I've just done this because, I mean, like space. Oh, a very good question. Thank you. So I've continued. I've cut it because of space. Right? For you, you have to continue. It's one statement. You know?
Okay, thank you.
How much do you find?
The total of this is 101.50, and then the difference from the contribution will give us 249,850.
This is 150,000.
No. The total of the fixed cost is 150. So less that from 350 will give us 249,850. So the difference is 249,850.
Okay. You are saying 10050 like this?
Yes.
Okay. Then the profit?
That's 249,850.
249,850. That's the net profit. You got it?
Yes.
It's net profit. But if the value is negative, then that's not net profit. Okay, obviously you know what that means. If the value is negative, then you have a net loss, right? It's not right to say net profit when the figure is a negative figure. Yeah? You say that this is a negative figure, and then that's net loss. Okay. Yeah. Any question so far? You have reached to the net assets, the net sales. Do I have any question?
No question. I think we just need to internalize this to go through over and over.
Okay. Let me finish doing the work. So now, when it comes to the second month, which is what? Which is the month of February. You see, the only difference that will be here is that we are going to have the opening stock. Sales for February, how do you find the sales? It's the same price, 180 times what was sold in February, it was 6.5. Can you do that? Can we speed up now and do this quickly? And just do this with a few and I finish. Okay. What is the figure that is being found?
That's 1,170,000.
1,170,000. Okay. So 1 million like this. 170.
1 million.
Like
for
this?
me, I calculated
1,170,000. thousand.
Okay.
Is
What
it not
are you
supposed to be
finding?
224,000? 1,000,000 224,000.
You see the figures that you're multiplying. It's 180 the selling price times 6,500.
Oh, okay. I think I made a mistake somewhere.
So it is 1,170,000. Okay. 1,170,000. 1,170.
Yeah, correct.
Okay. Then from there, what do? We less production cost. Now, pay attention quickly. I will speed up a bit now because you have an idea. You need the opening stock. So the opening stock shall be the closing stock that you had last time, okay? Your closing stock that you had in the previous month in January, which was 132, yeah? It was 132,000. That closing stock shall be your opening stock in the new month. Did you get that one? Yeah, you got it. Direct material. Then for direct material, you know how to go about it. Get the cost. 55 times the level of production is 80,000 now. Production is 80,000. You can do that, I think, at a faster rate. You know. What does that give us? 55 times, you know.
That's 440,000.
Okay, 240. 240.
No. 440,000.
Okay, 440. No one is getting lost out of this. Direct labor, need direct labor now. Direct labor costs. What are we finding about direct labor? 45 times 8,000. What are we finding?
Uh, 360,000.
360.
How did you calculated labor? Sorry.
Like you get the labor cost per unit. Are you able to see it? Direct labor cost per unit is 45. 45 times the level of production in February was 8,000. So it's, you know. Okay. Then we can get the variable production overhead. 10,000 times the 80,000. I think that should give us 80,000, isn't it? The variable production overheads give us 80,000. 80,000 times 10, it should give us that. Then we can consolidate all these. Okay. We can add all these, what we find as the total cost, production cost.
880,000.
880,000. Now, we need the closing stock from here. Obviously, you have to memorize this now. You're almost there. Closing stock. How do you find the closing stock? This is where you need to pay attention one more time. It is the costs multiplied by the units produced minus units sold in the period. Okay. Let me write like this now. Minus the units sold in the period plus the remainder that you had previously. Remember, in the previous period, there are some units that were not sold. Let me call that R. Remember, then plus the production levels. So the costs is 880,000 multiplied by, let's go back now to the units that were produced. For February, it was 8,000, yeah? 8,000 minus 65, what do we get? 8,000 minus 65, what do you get?
That should be 1,500.
1,500 plus the units that were not sold in January. It was 7,000 minus 5,800, which was 1,200, right? So
Yes.
it is 1,500 plus 1,200 that were not sold. And what we find here in the bracket. $1,500 plus 1,200 divided by 80,000.
That's 27.
Okay, 27. Okay, divided by 80,000, the 80,000 units that were produced. Let's find the closing stock. What do we find as the closing stock? Quickly, we can find the closing stock here.
I'm getting 297,000.
297,000. So get the difference of that. We push it in the middle column so that we can add to the opening stock. What's the difference?
That's 583,000.
583,000. So you can add this to the opening stock. What do we get? Hoping that we have not lost anyone. Everyone is okay.
That's 715,000.
715,000. 715,000. So to 715, we can add now the non-production variable costs, which are the variable sales and marketing overhead. So you say 8 kwacha per unit times the units produced 8,000. 8 times 8.
That is 64.
That's 64,000 plus is 790 and 15,000. What do we get? And that is what you're going to deduct from the sales.
That's 779.
779,000. So what is the contribution? What is the contribution?
391.
So the contribution is 391,000. Then from the contribution, what do you do next? You less all the fixed costs, isn't it? All the fixed costs. Now the fixed costs are like they're fixed per month. We start with the production. The production fixed costs, they stood at 35,000 previously, isn't it? Like the note says that. It says that the production fixed costs are at 45,000 per month. So they will still remain the same. It's monthly. So write 45,000. Then you have the sales and marketing production overhead. This stood at 35,000. The question specified administration. This is stood at 20,150 per month. Where are we getting these figures? In adjustment note number 3. That's where we're getting those figures. Like they're given per month, fixed figures. So when you consolidate all that, what do you find?
It's the same 100,150.
100,150. So what is the net profit or net loss?
Uh, 290,850.
290,850 as a net profit. Is this hard? No, sir. This is easy. We are following. Okay. Let me do this.